All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down the SPY. All right, we're also going to take a look at an individual named Walmart. Looks like it could be breaking out of its recent downtrend. Some Discord members got into this, I believe, here recently. We'll break down TNX, and the reason being is because if you're trying to trade treasury yields and the stock market also, you really need to pay attention to, treasury yields, and the TNX is going to be the most common. All right, and one of the most important ones to look at, that's going to be your 10-year treasury yield. We did get the breakdown scenario and hit our first price target. We'll talk about some targets to the downside and the potential for a bounce. Now, this is TLT right here. And as a result of TNX breaking that bullish channel it had to the upside, TLT has had a very tremendous rally. We hit our first price target here, our next level of resistance up here at 94.74. You can see that's exactly where we're at pre-market at the time of this recording. All right, and then we'll zoom back out and take a look at a weekly time frame for TLT. As it appears, we did put in our wave 5 bottoms. We weren't trying to call the bottom necessarily. We were just trying to look and see what developed back in those days. We're saying, hey, it's potential we could still go lower, but it appears we're getting that. And, after a 5-wave structure, you typically get an ABC correction. So we'll see if this ends up turning into an ABC or if this ends up, putting in a 5-wave structure. But this looks very promising, right? And it has TLT going up into the 120s, okay, into the 120s, potentially up to 142. Now, does that mean it's going to happen overnight? No, this is going to take a long time to develop. And this is a multi-year, bear market that TLT has been in. Right. And we still technically haven't broken out of this bear market. Right. This is the Dixie right here, the dollar. The dollar is going to be very important for trading stocks right now. Right. And you can see it had this very strong uptrend, and we do have a little bit of a falling wedge right here. We recently just broke out of this trend line. All right. We rejected, came back and bounced off of there. If the dollar is going to continue bouncing, okay, that could be a little bit of some headwinds for the stock market and for things like gold. Okay. So you do want to pay attention to the dollar here. And overall, it's still in its most recent downtrend, right? We're putting in lower highs, we're putting in lower lows, and we're just going to see how this thing develops. So you do want to pay attention to the dollar. But as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer, okay? You guys can join the Investment Intelligence newsletter. It's a completely free newsletter for you guys, giving out free trade ideas, free valuable content. These are what the trade ideas will look like, highlighting the conditions on the chart, and then show you guys the actual chart itself. Many trades in there have worked out very nicely. The newsletter is still relatively new. Okay, I think it's maybe 3 or 4 months old now. All right, this was a trade idea on SWK, highlighting the rising wedge, showing you guys where, the stock could potentially come down to. And you guys can also sign up for my Ko-Fi page. In there, that's where I book all of the 30-minute and 1-hour coaching sessions. You can also click on this buy a coffee button. It's basically a way to leave like a tip or donation for the free content I do put out for you guys. All right, the Investment Intelligence Discord is officially launched now as well. And these are many of the plays that we're in on the Discord. So in the Investment Intelligence newsletter, you get 1 to 2 free trade ideas a week. But in the Discord, you get access to all of the different analysis, all of the different trade ideas, and stocks and, crypto, bonds, ETFs that I'm looking at. All right, as well as other valuable resources and information in there. So, you can sign up for all of those things using the link in the description. The first thing we want to talk about here is going to be stock market seasonality, and this is going to be December market performance. Okay, so if you take a look, so if you take a look here, the beginning of December is typically choppy, okay? And so these dotted lines, they represent pre-election years, which is the year that we're in. Pre-election years are historically pretty good for the market, and obviously, both the S&P and the NASDAQ are doing very well this year. But it's typically pretty choppy the first half of December, and then the end of December is typically when you get that little Santa rally, right, as people like to call it. So, we'll see how this plays out and how this develops. So far, the beginning of December has been a little bit choppy. We've seen, a lot of the big tech name stocks, pull back a little bit, but we're seeing lots of market breadth where we're actually seeing, a lot of the smaller names and a lot of the other names in the stock market that haven't been participating as much in the rally, starting to catch up a little bit, right? So market breadth is looking pretty good. when you take a look at market sentiment, it's basically flatlined right here. Right now, it has gone up a little bit since the time of this, but overall, it's pretty much in neutral territory. We're definitely far away from euphoria at the moment, and it may not seem like it because of returns, but when you think about euphoria and you ask somebody around you, they're definitely not feeling euphoria. They're most likely actually upset. And there's lots of, bears in the market that are saying, hey, things are actually going to reverse and this is all a huge trap, right? Retail investors, all right, basically the optimism mounts as markets rally, individuals flock to stocks as benchmarks power grow higher. And so this is basically your meme stock crowd plowing into cross asset rally. It's lifting risky bets. So we've been seeing, lots of short squeezes in the market. We've been seeing a lot of these penny stocks, a lot of these meme stocks, really just absolutely skyrocketing. If we take a look, both CTAs and volume control funds look again to be buyers of the S&P 500, adding perhaps more pressure to the upside. And this was on December 2nd. And so essentially what you're saying here in kind of trying to get out of this statement is that hey, you have the potential here for CTAs and volume control funds to be buyers of the dip, right? There's been multiple times this week already where we've seen the stock market look like it's about to reverse and take a fall. We've been down 0.5%, 1%, and then bulls, there's just buyers, right? And buyers just keeps coming in and buying up the dip, as they say. Now, this is the S&P 500 on the top and the dollar here, Dixie on the bottom. And I mentioned you want to pay attention to these, previously, but the reason being is because they typically move opposite of each other, right? So you see the S&P dropping here, and then the S&P bottoms in October and the dollar rising. So they're doing the opposite. And when the S&P bottomed, last October in 2022, that's also when we saw the US dollar top, right? And that's not really a coincidence. From there, you start to see the stock market rally, you start to see the dollar drop. And then we saw this pop here in the dollar during the summer, and we saw the stock market drop during the summer as well. And now since then, the stock market has recovered and the US dollar has started pulling back even more. So if the dollar can continue its downtrend, that's going to be a tailwind for the stock market to potentially continue going higher. But as you can see, as we've had this recent uptick in the dollar, the stock market has started to cool off a little bit, right? And if we were to take a look at USD positioning, it's very light right now. This is the global FX positioning in the US dollar, and we can see it's actually below zero right now. So it's not like there's a bunch of bullish bets, on the dollar right now. We may be seeing a little bit of a bounce after, the move down that it's had, right? When we take a look at the move down that it's had, we're getting a little bit of a bounce. And when we take a look at this chart, we're bouncing off of a previous trend line right here. But the big question is, if positioning is going to continue to maintain to be light in the dollar, and maybe it even gets a little bit aggressive shorting the dollar, we would see the dollar drop, and this would be something that can continue to really push the melt up in the stock market. Now, when I say melt up, it's not a meltdown. Okay, some people seem to be confused about that. The melt up theory is basically that, hey, things are going to gradually and, kind of painfully grind up higher versus, seeing that V-shaped recovery that we already experienced in the SPY. Now, when you take a look at 2-year returns, this is a really great chart right here. So in red, we have the Magnificent Seven, and then in black, we have the S&P 500. And so people are really, really upset at the performance, right? They're only looking here at the performance of the Magnificent Seven, and they seem to have completely forgotten that these stocks completely got obliterated and were bleeding much more than the S&P 500. So when you take a look at the actual 2-year returns, the Magnificent Seven is only slightly above where it was 2 years ago, right, in November of 2021. And the S&P 500 also just barely above where it was 2 years ago, still not passing its all-time highs. So, when you put things into perspective, it really goes to show that, hey, everyone's all mad about this and saying, oh, well, this market can't last because it's only the Magnificent Seven, but they completely forgot about how obliterated these stocks got. And maybe these stocks got wiped out so hard, they sold their position, maybe down here, and they're experiencing a lot of regret at the moment. And that's why you see so many people upset and talking about the Magnificent Seven. Goldman Sachs has a good piece here on concentration. So concentration within the typical hedge fund portfolio and crowding across fund portfolios both increased during Q3 of 2023. The typical hedge fund holds 70% of its long portfolio in its top 10 positions, matching the highest concentration on record outside of Q4 2018. Their hedge fund crowding index registered the most crowding across hedge fund long portfolios in our 22-year data history. So keep some of this data in mind, right? They typically hold 70% of its long portfolio in its top 10 positions. And we take a look at the Magnificent Seven and the tremendous rally that they have. Over here, we're seeing a lot of people, basically saying, oh, well, it's not a good time to own the Magnificent Seven. And I'm sure that, a good number of the Magnificent Seven stocks make up a lot of the hedge fund's top 10 positions. And now we're seeing just that overcrowding, right? And it's super overcrowded. And so you have retail traders buying this up. You have, hedge funds buying these stocks up. And then you have CTAs buying these stocks up. And so there's really just so much just pushing these stocks up. And being that we're coming towards the end of the year, hedge funds and, asset managers, they have to, if they haven't been in these names, they have to, basically try to catch up before the year is over, because if their portfolio isn't even up to pace with the returns of the S&P 500, they're going to be getting questioned, right? And so, their investors, they're going to come to them and say, hey, well, what are we doing? Why is the NASDAQ, up, double digits right now, up 30, 40, 50%? We'll see where by the time, the year ends. And, we're only up 9% in our portfolio. Why don't we have more NVIDIA? Why don't we have more Amazon? How come we didn't have more Apple or Microsoft or Google, et cetera? So that's why we're seeing so much crowding in these positions. Essentially. And so that's something that I just really wanted to kind of go over. And this is another thing that's really been supporting and helping this whole melt up theory that I've been going over. The insider transactions has been skyrocketing here as well. And so basically we are at a point where it's getting a little bit bearish, right? And so we're basically at a 30-to-1 ratio for the insider transactions ratio. And, according to this, all right, from Reuters, this would be bearish. So, we'll see. Maybe if the dollar really starts to tick up here, maybe if we see treasury yields start to tick up here, then we could see a little bit of a pullback in the stock market, and maybe we start to see, this cool off a little bit. But when it comes to insider transactions, that's actually been one of the things that's been helped propping the market up. All right, we've been at the highest level of insider buying. And basically, companies announcing buybacks, they've been buying tons and tons of stocks and announcing tons of buyback programs. And that's been another thing that's really been helping the market just kind of float higher, right? And just continue grinding higher when everyone thinks that it's due for a pullback. Now, domestic equity fund flows, when you take a look at ETFs and you take a look at these fund flows, it's just absolutely skyrocketing up here, right? This is a 4-week average. And so you take a look at, December of 2022, right? And we're seeing negative inflows. We're seeing negative flows into ETFs, which are going to be the light blue, right? And mutual funds, negative flows, right? And then here we go into March. And this is right around that banking crisis, towards the end of the banking crisis. We just see that it's just absolutely skyrocketing. And the flows into ETFs is just, the highest we've basically seen in over a year, And this is another thing helping prop the market up, as people with their 401ks, or as people pile into these ETFs. Some of the big names out there, like Apple, for instance, they qualify for many different types of ETFs and, strategies, right? Whether it's growth, or sometimes even in areas of like value company and different things like that. A lot of these Magnificent Seven stocks are going to be beneficiaries of these large ETF fund flows and inflows. And so that's going to result in, people buying the underlying stock and, continuing to just see that grind up higher when it comes to the stock market. Now, this is the soft/no landing consensus for 2024, and basically 75%, so 3/4 of people are pricing in a soft or no landing, and only about 20% are pricing in a hard landing at the moment. So, if you take a look, it's basically the soft and no landing expectations are back to their summer highs. The hard landing fears are easing at 21%, and 2 out of 3 fund manager survey investors see soft landing as their base case scenario. for the global economy in 2024. This is something that can be a little bit worrisome because oftentimes whenever you see these high elevated levels, a recession does end up following. So, there are things to be concerned about in the economy for right now. The narrative and a lot of the data has been coming out favoring, the economy and suggesting that the economy is stronger than a lot of people thought. I've got some good videos coming out very soon going over some of the things we do need to be concerned about. But I want to bring up this Goldman Sachs top 5 snapshot. And so basically, these are going to be 5 stocks across 4 different categories. So upside to price target, they have WW, FSLR, BBWI, QTRX, NVIDIA. You guys can take a screenshot of this and, just take a look at some of these individual names. When you take a look at the upside to consensus EPS, it's going to be WW, BA, Apple, OKTA, PPG. Revenue growth is going to be NVIDIA, FOUR, JEF, OWL, FSLR. And then the dividend yield is going to be SPG, CVX, OWL, SO, and JEF. So JEF making it in a number of these. You have NVIDIA making it in multiple of these. And you also have WW in here making it, in multiple of these. So you can take a look at these and see if there's any of these names look attractive to you. I just wanted to bring that to your attention. I know one individual name that certain members of the, in the Discord are starting to get into is Walmart, right? And we talked about this downtrend and looking for a break of this downtrend. We went ahead and went over some key support levels here. And you can see we bounced off of support here, and we're starting to get that breakout here and pushing up a little bit higher pre-market. If we were to rally, there's still lots of room. There's this huge blue box right here, which is a giant gap, right? And these gaps typically happen around binary events. In this case, it was earnings and the stock plummeted. And there's lots of room to the upside, right, if we want to fill this gap. But we do have to be mindful that these gaps can act as levels of resistance. And so 159.30, which is right around where the gap fill starts, is our 38.2% retracement level. So the 38.2 all the way to the 61.8, those are the 3 most common and well-respected Fibonacci retracement levels. And so you do want to be mindful of those. If we were to rally that, hey, we could stop short right here and potentially pull back, all right? But if we were to continue rising, there's lots of opportunity if we were to actually get that gap fill up there in Walmart. And from a risk to reward standpoint, and you're entering in right around here or here even, and you have a stop loss down here at that red level, and then you're targeting at the 38.2, or you're targeting the 61.8, or you're targeting the top of the gap fill. You can see basically you would be risking around this much to potentially make somewhere around this much. So from a good risk to reward standpoint, it does have a favorable ratio right there. Now, this is the SPY. We've been talking about how the SPY could be coming up to 462, which is this level. Now, ultimately, my wave 5 target is going to be 475. We had our large wave 3 up here heading into the summer, and then we got our pullback, our correction here for wave 4, and we came right down to the 61.8% level, right? We just barely dipped below it, but we did not stay below there, right? And so that's why it says bearish below, because if we were to flip that level to resistance from support, that was going to be very indicative that we could start a downtrend. We had my favorite pattern of the year, the inverse bump and run, and we can see that we got that inverse bump and run to play out perfectly here, take us up to where the pattern began, and now we're breaking out and we're dancing atop of this former supply zone right around 454, let's call it, and been holding that as good support. So 462 is the number where the stock market should go historically on average after 90% of stocks in the New York Stock Exchange are up in one day. The stock market typically gets about a 3% return. And so that was from over here on this around November 14th, I think. I can't remember the exact date, but 1 month from there, the SPY is up on average 3%. All right. And, can rally potentially up to about 18%. So we do think that the SPY will hit 462 right around mid-December. Will it be a little bit before? Will it be a little bit after? Ultimately, we'll have to see. We're not very far away from there right now. Just a few dollars, right? $5 or $4 away. So we could be coming up to that target very soon. We do want to be cautious though, because we've been hovering in overbought territory, and this MACD is very close to, getting a crossover to the downside right here, which could be a bearish crossover and lead to a pullback as it did here and as it did here, and also as it did right over here, right? So those are some things that I'll be paying attention to. Okay, when it comes to the SPY and the S&P 500, right? When we talk about the treasury yields, we talked about the scenario of, are we going to get this gap fill down here in blue and get a look below and fail? That was going to be bullish for TNX, for treasury yields, and bearish for the stock market. Or were we going to get the breakdown retest and push lower, which is exactly what we got. We retested this original bullish channel right here, and then we pushed down lower. We hit the first target here at 4.187. The next target below is 4.128. And then right around 4.05 is going to be the 200 SMA for TNX. And that is going to be, so those are basically your next two targets to the downside. If we get below 4, 3.921 is going to be your next target area. Okay. So there's a good chance for lots of support to be found in between these areas and for us to get some type of a rebound back in the TNX. Okay, so you do want to keep mindful of that, right? It's getting, it's not oversold technically yet on the daily time frame, but it is getting close to there. And we take a look at TLT, it's also getting close to being overbought. Remember, those are going to move in opposite. Now we hit that 94.74 level. We put it in a nice bottoming formation right here, which is this nice big large cup. And for me personally, the next trading opportunity I'll be looking for would be some type of a pullback. Right now, we talked about us, moving closer to that 200 SMA, which would be right around 95. And we actually got there a little bit quicker. So, the 200 SMA, if we were to continue rallying, would end up being around 96, which also aligns with this gap fill right here at 96, right? You can see we filled this gap over here, we filled this gap over there. And now we need to be mindful because we have two gaps to the downside, right? So you don't necessarily want to be over aggressive or have no type of risk management in case we were to reverse and fill the gap down to about 88 or potentially down to about 85. But we're definitely nowhere near there right now. So it's not something that we're planning on. If we were to look to play gap fills, we're much closer to this gap, and this gap up above, right? So those would be the ones that we would look at if we can get above 94.74, potentially get that 96 gap fill, which is going to be right around there near that 200-day moving average. And if we continue to move higher, that would put us into that overbought territory on the TLT. And so, now's maybe not the best time to be chasing, not saying that there's not any upside potential. As you can see with this arrow, we're kind of anticipating it coming to this 200 moving average. But for right now, I'd prefer to see some type of a pullback for a potential re-entry, and that would give us a handle, right? So we already talked about we have this nice cup formation here. If we do end up getting a nice little pullback, maybe fill this gap or potentially even fill the second one, then we would look to see, all right, well, now can we form a handle around those areas and find support to establish, another run to the upside? That's something that I'll be paying attention to. This is TLT on the weekly chart, and so when you take a look, this is from 2020. Guys, TLT has been in a bear market for 3 years. If you didn't know, okay, the bond market has been in a bear market for 3 years. So you have 1, 2, 3, 4, 5 down. All right, and typically after a 5-wave correction, you're going to get an ABC up. That again, we talked about the 38.2, 50%, and 61.8. Those are going to be the three most common and well-respected fibs. And so if we were to just retrace to the 38.2, that puts us at 120. But if we were to retrace to the 131 or to the 50%, that would put us at 131, or the 61.8 would put us at 142. So, keep in mind, this took 3 years to play out. So this is not going to happen in 3 weeks, right? It's not like we're going to 120 or 140 in 3 weeks. We're just trying to get a broader sense of the macro view and the potential of where TLT could really be heading, from a longer term standpoint. So that's pretty much it for today's video. We're going to wrap things up here. Don't forget to head to the Ko-Fi page. All right, click on commissions. That's where you can book a 30-minute or a 1-hour coaching session. I do those sessions all the time. We can go over options, analysis, different strategies, whatever it is you would like. You can also join the Discord. Okay, the Discord is only about $10 a month, so less than a cup of coffee a week. All right, and that is where you can basically figure out the trading strategies, and I have custom scripts and indicators for all of the Discord members that will chart the strategy for you and do it all for you, and then you just simply have to learn how to execute. That's where we're getting really good returns on these day trades, such as 300% trading options. That's where we're getting really good returns, and you guys, these are all of the swing trades. You guys can see all of the different trade ideas, all of the different analysis that's posted as well in the Discord, along with the resources and other things. And if you don't want to sign up and pay for anything, I would definitely join the Investment Intelligence newsletter. All right, that's completely free. And if you're fans of free, valuable content and free trade ideas, you're going to love the newsletter. I try to sprinkle in 1 to 2 free trade ideas a week for everyone.